Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today, we're diving into a filing from Aspira Women's Health, and let me tell you, it's a bit like trying to decipher a doctor's prescription. It looks complicated, but we'll break it down. Get ready to find out how Aspira is planning on staying afloat with a fresh injection of cash. Will it be enough, or are they just kicking the can down the road? Let's find out. So, what's the story here? Well, Aspira Women's Health just announced that they are getting $1.37 million through a private placement. Basically, they're selling securities, specifically what are called senior secured convertible promissory notes, to some existing shareholders. Think of it like borrowing money, but instead of a bank, it's coming from some of their current investors. This happened on March 5, 2025. Let's talk about these convertible notes. It's essentially a loan, but with a twist. The note is convertible, which means that instead of just paying back the money, the lenders, in this case the existing shareholders, have the option to turn the loan into company stock in the form of what they call units consisting of 1 share of common stock and 2.25 warrants. It's senior because if Aspira goes belly up, these lenders get paid before other creditors. It's secured because Aspira is putting up some of their assets as collateral, meaning the lenders can seize those assets if Aspira doesn't pay up. Now about the interest. Aspira will be paying interest on these notes every 3 months, and here's the kicker, they're paying it in kind. Instead of paying cash, they're adding the interest to the principal amount of the loan. The interest rate will be based on something called the applicable federal rate, which at the time was around 3.34%. These notes are set to mature or come due around March of 2030, unless they're converted into shares of stock before that time. The conversion price, the price at which the lenders can convert their loan into stock, is $0.25 per unit. Also, Aspira has the option to force the lenders to convert their notes into units if they manage to raise a total of $4 million or more from selling these notes and selling any other stock or warrants after this deal. Let's talk about the warrants. Remember, these are part of what the lenders get when they convert the notes. Warrants give the holder the right to buy shares of Aspira's stock at a set price. In this case, the warrants can be used for 5 years. For the first 2 years, they can buy shares at $0.25 each, then the price goes up to $0.50 per share. The company also granted these investors registration rights. This means that Aspira will help them register the shares of stock they get from converting the notes, so the investors can then sell those shares to the public. Finally, on March 11, 2025, Aspira put out a press release about this deal to let everyone know what was going on. So what does all of this mean? Let's step back and look at the big picture. Aspira Women's Health is a company focused on women's health, particularly in ovarian cancer risk assessment and management options. But like many companies in the biotech and healthcare space, they often need to raise money to fund their operations. Looking at the numbers, Aspira's situation seems delicate. For the year 2023, the company had a tough time. Their cash on hand was just under $7.3 million, and they burned through about $26.6 million. This means they needed to find ways to get more money or risk running out. In the first half of 2024, they managed to get around $13.3 million from stock sales, but they still ended up burning through another $13.2 million in cash. So while their revenue showed some growth, costs went up even faster. Now jumping to the end of 2024, the financials tell a similar story. Their cash reserves were down to about $7.7 million. They spent about $25.3 million, a bit less than in 2023. Their revenue increased, but they still faced a significant cash shortfall. This pattern indicates that Aspira is relying heavily on external funding to stay afloat. This latest move of raising $1.37 million gives them some breathing room, but it's not a long-term solution. So what's the good here? Aspira has promising products and the women's health market is growing. Their ability to innovate could lead to better solutions for patients and greater market share. Also, new strategic partnerships could expand their reach and revenue streams, reducing their reliance on external funding. However, there are some red flags. Aspira is burning through cash at an alarming rate. If they don't find ways to significantly cut costs or increase revenue, they'll likely need to keep raising more money, which can dilute the value of existing shareholders' stock, and it could happen again very soon. Also, the convertible notes are not ideal because they add debt and increase the risk for investors. The company is in a competitive market and it needs to adapt. In conclusion, Aspira Women's Health is at a crossroads. They have the potential to make a real difference in women's health, but they need to get their finances under control. This latest funding round is a temporary fix, but it's not a sustainable strategy. It remains to be seen whether they can turn their innovative ideas into a profitable business before they run out of cash. Thanks for watching. If you found this breakdown helpful, please give us a like, subscribe, and let us know in the comments what other filings you'd like us to decode. Until next time, stay informed, stay curious, and keep decoding.